Unmuted.
All right. Chu, I see you there. Anybody else? Hey, I'm glad you're back. Sorry for the tech problem. This is a weird one. It just literally blew up. It just poof, gone. It is Friday. Since it's just you and me, you know what actually bothers me about this? It's not so much GoToWebinar going poof and going gone and being gone, but what happens when these things are driving our cars? What happens when when you've got a it is coming. You're right. What happens when we have an 18-wheeler or a row of 20 18-wheelers shipping stuff for Walmart and its computer goes poof all of a sudden? all controlled by computers just zipping down the road. I don't disagree with you. I think that we're going to have a fairly quick shift. I don't think it will be obsolete. I think you'll still have quite a few people doing it, but I think it'll be getting less and less and less. Brett, Ben, good to see you back here. Sorry for the tech issue. Chu and I were just chatting about the thought of, a computer program going, blowing up on me or going away. It's a little annoying, but what happens when these things are driving our cars or driving 18-wheelers shipping boxes of stuff between different Walmart locations? Last thing I want is to see a Microsoft blue screen of death on a computer that's controlling an 18-wheeler driving down the road. Kind of a bizarre thought. But we are making it easier once our robot overlords actually take over the world. At least we've given them all kinds of computerized large vehicles to drive around and control us with. All right, getting everybody back in. Looks like we're getting back rolling here. Just having a little fun with that. So what does everybody who's here at this point think about AMAT? Chu, you're in for holding on to it for another week. We see, Brett, did you say the size of the trade was pretty small for you? Rob is holding on to it. Who's the person who just said the size is pretty small? Yeah. Okay. From practical terms, Brett, that's actually good. I just want you to kind of get in your head. Always think in terms of percentages and returns, percentage returns. The reason I want you to do that is because if you're making a decision that you're not going to lose much because it's a tiny trade, what's happening is you're training yourself to kind of look at the wrong thing. You want to be trying to look at how efficiently are you using your money. I agree, a small loss, maybe we just play it out and see how it goes. But what we really want to be doing is, constantly thinking about how well are we using our money and how well are we creating a return for the risk. So for you, skill-wise and being a good trader in the long run, always think about it, is this a efficient use of my money? Is it a good use of my money? Even if it's a tiny amount, it's the process of evaluating it on those terms that's going to allow you to manage your real big portfolio in a much more efficient way. So, just keep that in mind, because that's gonna really matter to you in the long run. Making good decisions on how well are you using, whether it's $50 or 5,000 or 50,000. How well is that money being put to use? The nice thing is that also allows you to evaluate one trade versus another trade, despite what size it is. So, all right. Rob's for holding it. Anybody else around the room have any opinions, any thoughts on this one? Jim, Larry, looks like you're offline here. Sandeep, Ben, Brett, anybody? Hold or kill it? Anybody else? Yes? No? I'll tell you what, my thought on this one, I'm not overly confident that we're going to get a big move here, and I'm a bit worried about the drop. It's not strong, but just to give you, just to give you my thoughts on this one, I would probably close this. Not strong opinion to close it, but I would probably just close it. But if you guys want to roll with this one, and everybody understands what we're dealing with, I don't have a strong enough opinion on that to say you guys are just crazy to hold on to this. I'm willing to go with it for another week, but I want to keep a pretty close eye on this. I'm worried that that theta erosion is going to eat into this, and I really do not want to see this get up to that $2,500 loss. I think it'd be a waste of money for us. But if most of the people at this point have voted to say hold on to it. I can't say my opinion's extremely strong in any direction. We're kind of in a bit of a fuzzy spot on this one. I can absolutely agree that there's a good chance that we might get a drop, but I'm very worried that the theta erosion is going to nibble into this trade each day. So, can't view the screen. Hold on. All right, that was my error. Sorry, I didn't press the button. Can you guys see it now? Okay, yeah, that was my, sorry, get distracted from this whole blowing up computer thing, and I didn't press the button to share. So yeah, we are in this kind of a fuzzy, Rob, that's exactly it. We're in this fuzzy decision mode. If you want to play it out, I'll play it out. Otherwise, we can also make the choice to just cut our, losses and walk away right now. I'm willing to go in either direction. So give me any further thoughts. Most of everybody who said something right now has said keep in. So the votes are stay in so far. Is anybody against it? Going, and gone. All right. I will keep an eye on that. I am going to cut it if I think that it's stagnating too much or if it's settling down too much. So I'll send out the alert if I see that situation. Facebook. Pretty straightforward one on this. We have a bull put spread. 135 by 140. We've got 35 days out on this. Facebook is currently trading at 149.74. Now, a couple of things that have happened. First of all, the strikes we chose and the distance we chose for this thing to be out in the future, it worked out great for us. I mean, we had Facebook do some nasty things. Now we have time. We have plenty of distance in here. If Facebook had kept going up like we thought it might, and had every indication it might, we would have been in a pretty, approaching a good solid max profit at this point and be considering exiting. We're still at a profit though, and we're still at a decent trade. Question is Facebook going to recover much? And also, is Facebook's implied volatility going to drop a little bit? I would expect that to happen. I'd expect IV on Facebook to be shifting down, settling back down to where it was before the nastiness last Friday. Drift-wise, I think we're probably stable. I doubt we're going to be going up a lot. Probably just waffling around sideways here. I guess we'll see. Your profit targets got hit. Jesus. Mine didn't, Brett. I don't know why. I'm glad they did. That's awesome. Yeah, I'm not sure I'm seeing any kind of strong indication that the markets are going to go down in any way. And, seasonal effects are pretty fickle. If anything, I'm just going to mainly follow what the general market is doing, which is bullish at this point. But it's bullish with a lot of risk. So just keep that in mind. Let's see here. So I think at this point, leaving Facebook on, we've got plenty of room. I don't think we're at risk of it going all the way down to 140. Pretty much just let it do its thing, and we'll keep an eye on it. Google, 895 by 900. We are trading at 951. This is pretty much the same situation. By the way, a big chunk of the money that we lost from our profits in this was mainly wrapped up in implied volatility going against us. So let me see, is that Google or Google? No, Google. Once again, down here, we're almost in exactly the same situation on Google. IWM. Let's see, we have 120 by 123 bull put married to a 148 by 151 bear call. Mark on this one right now, we've got about 21 cents in the put side of the trade. We have about 48 cents on the call side. We are making money on this. There's lots of time in this. This is a very, very wide trade. Still looking for that opportunity to close out the puts. Haven't seen it yet, but we're have plenty of time for this thing to work out. So basically watching that. NVIDIA, back ratio. This one may be a little bit more of an interesting one for us. We are in a actually pretty solid profit on this right now. Let's take a quick look at this one. Hold on. $10 by 20, 141.55. Sorry, there's so many pieces floating around on here. Okay. Go away, go away, go away. The trade that we are in right now. Currently, NVIDIA is at 152.92. And we are in a small profit right now. We're actually in our profit zone on this trade. Let me just double check that volatility hasn't been shifted on this. Nope, good. All right, we're in a really interesting spot. Volatility on NVIDIA jumped up a lot. Now, the back ratio, because it has that large, or has that extra put in it, has a long volatility component to it. So when implied volatility went up, it actually improved our trade. This is a really kind of almost unique spot here. This is wrong somehow. Oh, it's the wrong day. There we go. We actually don't have a place in this trade as of today where we can lose money. Now, to make more money, we need to have it continue to move up or potentially rapidly move down. But we're in an amazingly good spot. But going forward, we're going to have very, very mild theta erosion in the near future. But here's something that I'm worried about a bit more than theta erosion. Volatility going down. Because if we have, let's see, right now we're up around 42, 43 on the volatility. We drop down to 35 or so. Let's take a look at what happens to trade. So 43, let's just subtract. I'm just roughing this. I just want to get a sense of what's happening. If I subtract 8%, well, actually, you know, at the spot we're in right now, it's not that bad. If we were over in the middle, the drop in implied volatility would hurt us a lot more. But considering where we are physically at right now, it would hurt us a bit, but not horrendously. And then eventually time erosion is going to be on our side and actually give us more profits there. What we really need, though, is NVIDIA to move up. We need it to be strong. We need it to go, you know, bullish. or we need it to utterly fail. Right now, I think we're fine on this. We don't have any major crisis, and even the theta erosion on this is not going to kill us over the next couple of days. We're in a good long-term spot as long as we can stay at this level or go higher. We're even better. So I think on that one, just pretty much hold. And that brings us to the end, short of our hedges and a let me see, 1450. Okay, separating this one out is an absolute pain in the butt, but we also have a VXX calendar. Hold on, something strange about this one. Sorry, just going back to my notes on this one. Yes, no, it's expiring today, which is, I just want to make sure I got all my notes about what was going on here. Okay, that, it's always tough when I've got these mixed in with everything. I wish there was a cleaner way to manage these. All right, we got into this trade at 46 cents. The calendar spread gives us, is actually giving us a decent little profit at this point. Nothing outrageous, nothing huge, but it is going to be a profit. We have to be out of this thing by this afternoon. We do not want to leave those long VXX options there. Currently, VXX is trading at 13.14. If VXX goes up towards the 14.50 strike, we're going to make a lot more money. We're at a very sensitive point today. If VXX or volatility in VXX moves up, even small amounts of movement on that are going to be a very positive thing. But flip side is if it moves down, it's also going to be a pretty serious pain in the butt thing. So we need to make a judgment call. We have a profit. We got money in hand. We got into this at 46 cents. We can get out roughly around 54 cents. I'll tell you what, while we're in the class today, just because we do need to get out of this thing, I am going to put in a profit target of 56 cents. But by the end of this class, I want to revisit that and basically make a judgment call if I have to shift it down. Now, why am I doing this right now? I'd like the market to come to me and give me a couple extra cents credit, and I'm willing to be a little bit patient for that. Shouldn't be hard to do. Just let the market do its job. If we get hit, we get a couple extra cents. If not, we reevaluate near the end of the class and maybe shift it and do an exit order to get out. But that is where I'm going right now. So anybody? Chew, why don't you let the June 16th option expire worthless and sell the July 14th on Monday? Let me show you why. VXX, we've got a 1450 call that expires on July 14th. Okay. Well, it's not horrible, but here's a couple of things that could happen. We would be left with a plain old 1450 long call. Now, if we got rid of this on Monday, we've got today, we've got Saturday, we've got Sunday, we would be losing, let's see here, 4.5 to 5 cents on the trade purely from theta erosion, waiting for that to happen. That's just what the theta erosion over the weekend is going to be on this. So it would put us, let's assume it was 5 cents, it would put us at the equivalent of getting out overall at 51 cents because we're going to lose that theta erosion. Now, if we have VXX move, we've got at this point a long option which has got 39 cents or 35 cents worth of delta in it. So if VIX were to go up, that would be wonderful. I mean, we would make 35 cents right off the bat, or 34-ish cents right off the bat. But if VIX were, or VXX were to drop by, $1, we would be losing 35 cents, which would immediately put us into a loss on this trade. Whenever you leave a leg out there, what you're doing is you're leaving a brand new trade which has got a totally different set of risks and a totally different set of ways it works. The trade that we've got right now works because the long option and the short option were balanced against each other. And for the amount of options that we had in here, 100 of these things, actually, just a quick little note, if we had VXX drop by $1 between now and Monday, we'd lose basically 5 cents in theta erosion, plus we would lose another 35 cents here. That's 40 cents times 100 is 40 times 100 would be a $4,000 loss. So what's happening is you're just exposing yourself to a very, very risky situation. Flip side, VXX goes up by $1, you made $4,000. That's great, but it's a very different trade. Never, ever, ever just leave chunks of trades around, because when we create trades, we're very typically using a lot of contracts very tightly balanced against each other. It's a kind of a precarious situation. They work because the prices are linked. Once you uncover that, you suddenly expose yourself to quite a bit of exposure overall. So just be careful. I probably wouldn't recommend doing that. I would close this out entirely before the end of the day today. Now, here's the other option for you if you really wanted to do this. Now, and you could do it if you believe that this is a good trade. You could close the short option out and then choose a future expiration and sell another short option. It then creates a brand new calendar trade. It's got its own, it's got its own benefits. It's got its own deficiencies. It's got all of its own features. Treat it as its own trade. Evaluate it, figure out whether or not that's a smart trade or a good idea. And also ask yourself, is this the right way for me to use my money? Because if you close the whole trade, you get your money back, you can use it somewhere else. Would you be better off using it somewhere else? But if you come up with an answer that says the resulting trade is good, take it. That's fine. But go through those steps. Never do it just because you could do it. You end up, very often that ends up leading to very risky situations. So, Chu, does that make sense for you? Does that the concepts make clean sense? Good. Can we test out the June 23rd and July 14th? Sure, we can test it out. I'll tell you what, I'm going to put this order in to exit this. Wow, this is actually going up in our favor right now quite a bit. Actually, let me check something. Before we do anything, one thing we really should be paying attention to, what I should have paid attention to, let me get rid of some of these. Oh, come on, Thinkorswim. Why will it not take those off? What I wanted to find out was whether or not we've got a strong theta erosion factor in our favor right now, because we might be better off just holding on a little while, into the day to let the theta erosion just put some money in our pockets on VXX. It would be a risk against the idea that VXX might drop in price, but could make us some extra money there. Always good to pay attention to that, especially in the last day. You wanted to check real quick. By the way, it's not letting me clear out some trades, so it's making this whole P&L chart look really wrong. You wanted to try out the 1450 using the June 23rd versus the 14th of July. So I'd be going long on the 14th of July. Short on this. Netting ourselves a 40-cent debit. Overall, we've got about 16 cents worth of money that we can make in there. Let's see. Let's see if it even lets me analyze it. Thank you. Okay, so Chu, here's what you've got in front of you. This trade is, this trade right here would be outstanding, like really, really strong if VXX goes up. It would also be very risky if VXX goes down. So we're on a pretty steep slope here where a small amount of VXX is going to, a small amount of VXX movement is either going to make you quite a bit of money or take quite a bit of loss. It's going to be a very challenging trade to manage. Now, here's one thing that you've got to pay attention to whenever you're trading VXX. It has a weird relationship with volatility. If VXX goes down, what's going to happen is the volatility in VXX is going to drop, which means that your loss is going to accelerate. Let me show you what that would look like. Let's just assume VXX implied volatility has got about 70% right now. Let's assume that it drops just 10%. And that would be happening as VXX was going down. That's a very different relationship with implied volatility than almost every other symbol has. But if it does that, you are going to be pushing down into a faster loss. Now, the flip side of that is that if VXX starts going up, it means that volatility in VXX also, and the VXX options also increases. And that happens very, very fast sometimes. In that case, we could be adding, say, 15% volatility, which puts in a ton of profit into the trade and makes you, basically accelerates your profit and makes you make money faster. So if VXX did start moving up towards 1450 or so, likely to see a little bump in the volatility on the VXX options, which would help you make more of a profit faster. But the big question is this: do you believe that VXX is going to be heading back up towards 1450 over the next week, between now and the 23rd? If you strongly believe that, it's a pretty aggressive trade. You can do it. If you don't strongly believe that, I would say walk away from it. Fundamental question you absolutely want to ask yourself, these are just super basic questions, is that trade right there, and let me put this back to volatility being 0 or normal, is this trade right here over the next 1 week period the absolute best way that you could use the money in this trade, that you'd be committing to this trade? Is this your best opportunity to make a high amount of payment for the amount of risk that you're taking? If the answer is yes, go ahead and keep it. Use the leg that you've got, the 14th of July leg, to create your trade. If the answer is no, then close the whole trade and walk away. Just take your money back and go put it to use someplace else in the market. There seems to be this thing with people, everybody, myself included, that once you're into a symbol, you have this tendency to want to stick with a symbol or use a leg somehow. Well, there's really the only advantage that gets you. In fact, we have 100 shares here. So by using that leg for the trade, the only advantage it gets you is $100. That's it. So is $100 worth it to stick with a trade that may not be the best trade in the market? If this is the best trade, use it. But all you're getting from sticking with that one leg is $100 in your pocket. It's a little bit less commission. That's all. Could you make a better trade? Could you create a better risk-reward ratio? Could you find some other symbol that might be a better choice? If any of those was yes, shut the trade down, walk away. So does that make sense? Hopefully, what I want you to think about is the thought process in that'll help you make the best decisions when you're basically evaluating these on your own. There's nothing magical or nothing special, and there's really very little advantage to ever keeping a part of a trade on. And more often than not, it leads to making mistakes around risks and around exposure to problems. It's always a question, could I use this money better someplace else? Anybody have any questions on that? Any thoughts, opinions, discussions? Doug, you're crazy. Why'd you even say this? Everyone good? Or did GoToMeeting just blow up and shut you all off? Thanks, Rob. Every once in a while, I feel like tapping the screen. Is anyone there? Come on. So, Chu, would you take this? Because this is the trade you'd be getting. Rob, what was the profit you walked away with, Rob? Yeah, well, I'm planning on exiting this trade and walking away from the trade that we're in. I don't think I'm putting this on, but I'm just kind of curious to choose what your thoughts are about would you take this as a trade? Brett, you got out at 57 cents. Good. You're a little bit ahead of where we are right now. Actually, Brett, tell you what, I'm going to try to catch up with you. I'm putting this order out to close right now. We'll see if it hits 57 cents. Okay, let's move on. Let's get some new stuff. If you think it's going to stay between 13.50 and 14 over the next week, then my recommendation is not to take that. It would just be close the whole thing out, walk away. We've got a little bit of a profit. Let's use that money somewhere else. All right, somewhere else. We've got some opportunities out there. It's funny, overall, the market is not really cleanly, I don't know, it's not really cleanly anything at this point. Let me clear out some of this junk on the screen. Obviously, we've been in an amazingly strong bullish trend. I mean, this is just a SPY going up. Everything's just plugging away. Optimism in the markets are outstanding. I think we're looking at some good tax reform, regulations getting trimmed down, lots of things good for business, as long as nothing gets too horribly distracted in Washington and derails it all. So do I think that we're going to get necessarily a massive change in the direction of the market? At this point, no. I don't see anything that's immediate. Now, here's the problem is we've got the risk of that black swan event or gray swan or the flock of mini swans and the damn flock of seagulls effect. I don't know what it will be happening at any time. I don't know when it's going to happen. And yes, we could at any moment have a pullback. Valuations are high. Risks are high. Economic growth is okay, but not spectacular. There's some weakening numbers inside the jobs numbers, mostly in the participation rate. We've got rising interest rates. We've got potentially a shifting of money from stocks into debt. A bunch of different things that could affect the market. Are they going to happen tomorrow? Hard to say. Just don't have any clue on the timing of it. I want to try to get some things that are moderately bearish into the portfolio, just because I feel more comfortable if we had some things that had some bearish exposure and balanced off the bluntly fairly bullish portfolio we have right now. I also want to try to find some things where we can maintain some control. So, got a couple of different places we can go to on that. There's a few symbols out there that are just plain old bearish. Halliburton, Schlumberger, Let me get a little better chart on these things. As a matter of fact, if you go through pretty much the entire resource extraction, oil, energy, mining industries, we've got downward slopes on almost all of them, except for the absolute massive behemoths, your Exxons. And they can pretty much ride out the storm, whatever happens. We've got a lot of downward trends in those. A couple other areas that we're seeing some downward trends in. Things like Disney, mainly because of their exposure to cable news, ESPN, things along those lines. They are headed down, so there's another possibility. What's interesting, especially at Disney, is that their implied volatility is so low and they're heading down, that may actually create a very interesting opportunity for us. Other ones in the same kind of area, CBS is heading down. Oh, not MEC. What was some of the other ones that I had seen in this area? Well, CBS was the big one. Overall, there's some weaknesses there. I think that as an industry, cable and TV programming and things like that are getting a lot more challenges and getting a lot more competition. You're getting your Hulus, your Netflix, your all these different participants coming on strong, and and the value of things like cable channels like ESPN is just eroding too. Not that they do the same type of program, but everybody's focus is being divided in so many different ways. So there's an area that we can work with. Now, there's also another really interesting possibility too, which is on the SPY. We've got an excessively low implied volatility in the SPY right now, pretty outlandishly low. And it wouldn't take much for a little bit of a directional movement and quite a jump in implied volatility in the SPY. That would also give us some protection against downside drops. So let me just give you a quick question. What are you guys thinking? What direction do we want to head in? Energy resource extraction. Do we want to head into the content, the Disneys and CBS, or do we want to try to play with one of the big boys like the SPY as just a general baseline trade? Yeah, Jim, Whole Foods did get bought up by Amazon. That was a pretty crazy one. Grocers not acting well at all. Actually, let's take a look at that. Let's see, what is it? Kroger's, Kroger, KR. Ooh, wow. That one got kicked in the minority shares. Whew. Thanks for the heads up on that one, Jim. I hadn't even thought about taking a look at the other grocers, but man, Kroger just got nailed. Let me see. What are some of the other big names in the grocery business? God, is Jewel-Osco listed? I'm trying to remember some of them. Costco. Let's take a look. Wow. You know what this is? This right here shows you the power of the fear that Amazon can generate in entire industries. I mean, this right here, because Amazon bought Whole Foods, you do realize that pretty much nothing is going to happen in that industry because of that for at least a couple of years. Maybe they go and do some cool things with co-marketing at first with Whole Foods, but Amazon isn't going to swoop in and just instantly change Whole Foods. It's going to take years for them to develop out and move towards a new model. And I'm sure that, Bezos is going to do that. That's what he does. But this right here, this is just pure terror that an entire industry is going to get taken out because Amazon started playing, which is crazy. I'm not saying that they're completely wrong over the long run, but it's kind of crazy. So Costco, Target, let's see. Wow, Target's down. Look at these volatilities. Huge jumps in volatility right now. Now, well, Whole Foods is kind of out of the play right now. Once a company basically gets once an acquisition or merger for a company is announced, let's just take a quick look. I'll show you something on the options. Let's just go out a ways. I don't know, July 7th. You'll notice, look at the bid-ask spreads on these things. They're enormous. Almost instantly, once a company gets has an announcement that it's going to have a merger, the reason that these things suddenly become untradeable is that there's no real likelihood that there's going to be any kind of price movement. The price for the merger is announced, and anything that moves the stock price up or below that price gets arbitraged away almost immediately. Therefore, there's almost no reason to have any form of an option on it, and the bid-ask spreads go out to absolutely, unusable, ludicrous levels. In fact, I'm not entirely sure. You'd probably have to go for a really stupid price for anybody to even take the other side of your trade. So Whole Foods off the table. Amazon, on the other hand, my guess is they're jumping around like crazy right now. Let's see. Well, maybe not like crazy, but 21%. Ah, there we go. Now we're getting some updates. Yeah, that's what I was looking for. Yeah, there is a lot of activity on the options pricing right now at Amazon. It is just all these little flickers. These are people changing their prices, changing their orders, getting executions. There is a ton of activity going on in Amazon right now, but you can't do anything in Whole Foods. Yeah, Piggly Wiggly. This is the Mexican jumping beans, state for Amazon. As a matter of fact, my guess is that Thinkorswim is probably being completely overwhelmed with quote changes on Amazon right now. And what we're actually seeing here is probably a fraction of what's actually happening. And the streaming data on this is outrageous. You realize that there's over 80 gigabytes of data coming from the options market every day. And this is very, very tightly optimized, little tiny packets of information. It's huge amounts of data. All right, so thinking about trades, thinking about opportunities. Can anybody think of another pure grocery play? I'm just trying to think. I don't play in these too often. Kroger isn't a bad symbol to trade. But can anybody think of any other pure grocery plays? I'm not having any come up and right off the Rost. What is Rost? Ross stores. Ross isn't so much grocery. Well, I don't know. Does Ross have a groceries division? Ross is mostly clothing, isn't it? Well, yeah, Luther. We talked about that a second ago. We can't do Whole Foods WFM because they just got bought. So I'm looking at people in the same sector. So what do we have in the same sector? Does anybody, is Publix part of Kroger? Is that a separate independent company? Guys, help me here. Let me see if I can actually pull up a list of these things. Okay, comparables, people in the same sector. What do we got? Hmm. I know some of the big ones, Jim, like Jewel Osco, Publix, Kroger, obviously. Trying to think of any of the others, but not a lot. SFM, well, let's take a look. Sprouts Farmers Market. That's a new one for me. Hmm. Giant Beagle. that's a new one. I've never even heard of that before. Okay. Actually, Walmart. Let's take a look at Walmart. Walmart has a fairly decent grocery section. Ooh, man. Lots of value just disappeared on Walmart today. You realize how many billions of dollars that drop actually, represents? That's a lot of money. Super value. United Natural Foods. Cisco, Kroger. Well, let's see some of these things. Cisco, what is that? SYSC? SYY, Cisco. All right, Cisco got beat up. Calmaine, Calm. That's mostly chicken, though. I don't think that's... Calmaine got beat up, too. All right. Kroger, definitely one of the biggest victims right now. Since we've got this event happening, man, they don't have enough expirations to work with. I wanted to show you something that you can actually make a ton of money on if you happen to be watching the markets right when something like this is happening. Let me see if I can find something that is being affected strongly but has a really, really strong options chain. Let's see. Yeah, Costco, fairly big, but I know they've got plenty of options. No, that one's not strong enough. Okay, what I wanted to point out is this. A lot of times when you get these shocks to the market, just sudden events like, Amazon buying Whole Foods, and obviously we're seeing that this is shaking up an entire sector of the industry right now. Whenever you have those things, what happens is the short-term implied volatilities basically shoot up really, really high. I'm guessing that actually we've missed the opportunity because it's pretty fleeting. Like in the morning, if we had looked at this right here, I would have expected that the short-term implied volatility on the 1 week, 2 week options would have been crazy high, probably mid-30s, maybe even up to 40s or something like that. And as you go further out, what you would have seen is that the implied volatilities were not as high. In fact, they were probably, if you go far enough out, they were probably right about normal levels or just a little bit elevated. What's happening there is when the shock happens to the market, it impacts the short-term implied volatilities the most because they're the most exposed to the risks. There's a lot of uncertainty, there's a lot of doubt, there's a lot of craziness happening, and people are just trying to figure out what's going on. And a lot of times, people are hedging themselves, with their stock portfolios by buying different options. And most of the time, they're focusing on those super short-term options. They drive the prices way up. Now, I'm not going to dive into this for a trade because it's really more of a quick day trade. But what you can do is you can actually create a very short-term calendar trade off of these. Use the extremely high implied volatility in the short-term options against the cheaper implied volatility on the longer-term options. Now, you want to create a trade like a dual calendar that has a moderately wide range over which it's going to work. But the key is that you're going to get paid a lot on your credit side, and it's going to cost you far less on the debit side. Now, as things settle out, usually two things happen. If the event is actually a really huge risk, and it's going to continue to be a risk, the longer-term implied volatilities will move up a bit. And the shorter term ones will drop down to roughly the same level. And the two implied volatilities will basically settle in with each other and be pretty close after a day or two. And what you're playing is the drop in volatility on the shorter terms versus the kind of balance or stability of the implied volatility in the longer terms for a very quick trade that can be extremely profitable. But you have to be jumping on it right when it happens. And you have to be looking at it pretty quick. I would never put anything, outrageous for amounts of money in this. What you're also hoping is that you're catching it at a time where things have settled in and the prices aren't going to go absolutely nuts. What will happen is you're going to create in this situation, the high implied volatility in the short terms is going to create an opportunity which will make a calendar that's got a very, very wide break-even range. It's going to have lots of room for the stock to move, but you still have to have the stock stay within that range to keep, to make your profit and to walk away from it with money in hand. So it's a little bit of a balance. It's kind of more of an options day trading style of a trade, but since we're looking at this right now, I thought I'd just point out what does happen in these things. And, you can definitely make some decent money in it. I had a great, quick little Amazon trade the other day when we had that whole kind of flash whipsaw that we had. Okay, I'm going to jump back into doing some trades so that we can get some things knocked out here. Push, no options. Okay, thanks, Jim. Appreciate that. I just know Publix because it's so huge around me, and I know that it's a major chain. I didn't know if it had active stocks or options or not. Did anybody, what I just talked about with the shock in the market causing the short-term IVs to jump way high and using that to basically create a trade. Anybody have any questions about that? I mean, I just wanted to point it out because it's not, an opportunity to talk about it. But anybody have any questions on how that works? You can sometimes make some really great, literally 2-3 hour trades as the market settles down after something crazy happens. Some really good money in those at times. But you've got to be right there when they happen. If I was smart, I would have been paying attention and did it right when the market opened this morning. Everyone good? Okay. All right. I'm going to go right to SPY at this point, and I want to try one or two different things. So take a look at where implied volatilities are. Wow, very, 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 very stupid low. Okay. There we go. All right. I'm going to try, first of all, the back ratio spread on this. There's two ways that we can play this out pretty effectively. We've got a generalized trend on SPY. We've also got very, very tight bid-ask spreads in a very, very, very developed market here. We can get in and out of trades very easily on SPY. As we've seen before, calendars can work pretty well on this. We could put on a calendar with the idea that we're going to get, at some point in time over the life of the trade, a little bit of a bump in implied volatility. Calendar trades would probably be fairly directional on this, offsetting it by a couple of bucks, probably up. If the market crashed down, implied volatility on a calendar trade would jump up, and it would ideally basically protect us at least somewhat from drop. The other possibility is building in back ratio spread, which would be, in this case, somewhat of a bullish trade, and have a component that if the market dropped really, a lot, had a correction, that the opposite end of it would also be very profitable. I'm going to play with that direction first. So No, I'm not going to use those here. Starting out, I'm basically building into this a very, very, very aggressive bull put spread. In fact, so aggressive, my short strike on my put is in the money. So I'm going to start out with 242.50. And I want to have a relatively wide spread on this. The wider the spread, it actually gives me some advantages on this. So I am going to drop down to somewhere around 238.50. I don't have a set of formulas that say this is exactly where you should be on these. It's a little bit of a playing around with a trade until you get it tweaked. Now, this trade right here, 242.50 by 238.50 bull call or bull put spread, gives us a fairly aggressive, hold on, a fairly aggressive bull put spread. Now we're going to take some of this profit here. In fact, I might even need to be a bit more aggressive about that. There we go. I actually want to build in a fair amount of profit on this side. Okay, I think I've got something to work with there. Now, would I take this trade all by itself? Probably not. It's a pretty aggressive trade. It's designed to make money very, very strongly if the market goes up, but it would also lose very, very quickly if the market goes down. So the mix of risks on this one don't really work out well for me, but I do get quite a bit of credit off of it, and I am basically getting a lot of premium in the trade. Now, I'm going to trade off some of the premium in that trade for basically protection and for creating a kind of a buffer zone of risk in here. This is the ratio back spread that we played with a little while ago. This is 238.50. Okay. So in this case, all I'm doing is I'm adding another 10 contracts. Now, I just added it separately because I wanted to show you what was going on in these things independently. Truthfully, I can just add 10 contracts to this. I could have made it negative 10 by 20, and it would have been a ratio back spread. But I wanted to be able to show you that the fact that these two trades actually combine with each other to create kind of a third situation. So let me check the implied volatilities because that looks wrong. Yeah, that would be wrong. There we go. Now, what have we created here? We can make a little bit of money if SPY goes up. We've got a ton of protection over a period of time in the middle. And if SPY goes way down, we can make quite a bit of money. Now, I don't expect to necessarily make a huge profit down here. I would more likely be using this to protect myself and probably hit a profit target at some point. But this is a great way to protect yourself against the overall correction. Now, in this case, I don't think that I'm aggressive enough on the profits. I'm not getting quite enough money out of that. So I need to play around with the numbers a little bit. In this case, probably go up another buck. I may not actually be able to make this into a trade that I like well enough. There is a chance that that would happen. Depending on how the skew of the options implied volatility is, depending on how a lot of other things are working, we can sometimes get a really decent profit down here relative to our risk, or not so great. So right now I'm looking at about a $1,460 profit, probably somewhere in that general range, compared to, let me see what's the cost on this thing. Okay, I'm just going to change this over to custom, turn this into 20, and get rid of this. $1.46 credit versus $7 here. Okay, Margin cost on this is going to be $5.54. The most I can make out of it is $1.45, or actually $5.55 by 145. So 145 divided by 5.55. That right there is a 26% return. How do we get it? Basically, if SPY continues its move up in a reasonable pace, and ideally at the expiration of this, SPY is over 245.50 or at 245.50. If SPY moves up earlier, then we're even in better shape. We could close it out early, have a bunch of different things. If it goes up far enough, we can also come close to this. Now, let me make a point here. This is not going to be a swing for the fence, make a huge amount of profit trade. What it is a trade that's very, very controlled. So we're going to be giving up a lot of our max top line profit for the ability to control risks in the situation. Now, over the life of the trade, if we decide to take this, let's see what actually happens. If SPY were to go down in price, so let's see, where are we at right now, SPY? Let me just get rid of some of these things. Too much junk. Okay. Here we are, 242.11. If SPY goes up over the next couple of days, we're going to be moving up a profit curve here. And, as we hit around 245, 246 or so, we're going to be coming closer and closer to our max. If it drops, I'm here, everybody knows the answer to this, but if it drops, what's going to happen? If we have even a moderately significant drop, what's going to happen to implied volatility on these things? You guys know this one. And by the way, take a look at this. Implied volatility on these is miserably low. It's crazy. In fact, I might even want to tweak how I'm doing this. One little thing I'm noticing right now that you should be careful of is the implied volatility of my short options is actually really, really, really low. And it's a little on the scary side how low it is compared to my longs. That's actually hurting us on this trade. I would rather have these two pretty close, roughly the same level. Let me try something here. No. No. Sorry, my brain's not in gear. Oops. Oh, wait a second. No, still not doing what I want. Okay. Let me put it back the way it's supposed to be. What I was trying to figure out is a way to get an advantage by selling more of the expensive ones. This one may not actually work out so great for us just because of the difference in implied volatility. But let's take a look at the trade and see if the merits of the trade play out and see if it can work out for us. If we like the return versus the risk, one of the things we're doing over the life of the trade is tightly controlling the risk. And that, in a lot of cases, is going to be tied up in the implied volatility of the options. So if implied volatility of the options goes up, and it wouldn't take much for this to go up, easily could go up a good 5%. If I do that, what is happening? What didn't happen? Why did that not change? Okay. There we go. That's what I was trying to do. This is what we look like right now if nothing happens, and this is what we look like if SPY starts going down. the implied volatility spike, in fact, a lot of this trade ends up being a pure implied volatility trade. The implied volatility spike actually drives up the profit of our long options a lot, offsets any of the losses that we get from going down, and over the near term, we actually get moved directly into a pretty high profit on the trade. Now, as time passes, a lot of that effect goes away and it's less significant, but we still have quite a bit of time on this trade where we could be in a relatively little to no risk situation. If we hold on to it longer, the risks go up and we keep dropping down. So this is something I see as a definite opportunity here. It's a very controlled trade. It's more of a low risk trade. It's not a huge make a ton of money situation, but we could make a decent amount of money with a very controlled level of risk. Is that of interest? Do we want to roll with this one? Otherwise, I can go on to some other trades that we can play with too. Anybody? You guys are quiet. Must be Friday. And I have to be out of here by 12, so we got to be moving on this stuff. Not too eye-catching. So, Chu, what is it that you don't like? I mean, realize also, I want to make a point here. What are you seeing? Because don't let the chart itself, especially when the chart has these great big huge, dips off to the far end and the scale gets all skewed. Don't let the chart distract you from the fact that that right there is a 25% return over less than 30 days. Would you be happy with 25% return in 30 days with a very, very controlled risk? I mean, high margin, you say high margin, but it's 25% return on that margin chip. So I'm not really sure what's high margin about that. We would scale it based on however we want to do it. If you're looking for 100% return, then we'd have to take something with a lot more risk. Jim, if you think that the markets are going to flush or if you think they're going to dump, this right here is an excellent trade. This right here gives you a massive amount of control in those high-risk situations. This trade right here gives us the potential for a 25% return, but when and if that random tweet comes out, somebody, some news story comes out about, a Russian investigation, or Europe starts fighting about Brexit, or I don't know, anything random, a moderate amount of implied volatility going back into the market actually protects us a lot. Here we are a good chunk of the way through this trade. In fact, we're looking at July 5th, and our loss on the trade, as long as we had a little bit of implied volatility move in, if this trade goes completely down, ends up being $1,000 bucks. So there's a very tight level of control there. That control is extremely valuable. It's not for everybody. You've got to pick. Are you the more aggressive trader who doesn't care about that control and wants to make money faster and bigger lots? Or is the control valuable and helps you minimize your overall risks? Now, biggest risk to this trade actually is SPY moves down just a little bit and just starts stagnating. That would be the number one worst thing that could happen to this trade. And then we sit here and we're mostly being beaten up by theta erosion every day. In fact, that's very close to what we have in the applied materials trade right now. That's why that decision was hard. If it goes way down, we make out great. If it goes up moderately, we do well, especially if it does that in the near term. Big thing, the worst thing that can happen is it goes down a little bit and stagnates. So there we go. Yeah, it's a lot of hedge. Sandeep, if the market falls, okay, if the market falls, not even outrageously large amounts, this is our profit curve right here. And it goes up and it continues to go up. Now, Are we going to, are we going to make 15,000? No, we're very likely going to hit a profit target well before that, but we walk away from the trade with a good chunk of money in our pocket. And that is if the market does a complete fall apart, correction, crash, whatever. If we have a moderate one, let's just bring this back a little bit. If we have a moderate drop, just a moderate drop, and it happens sometime this month, say in the middle, near the end of June, we get a little tiny bit of implied volatility on it. We're still making money across this entire range. It's not much, but let's say we drop down to 240, which is not a huge drop. In fact, it's barely a drop. Let's go down a little bit, 238. If that comes with a bit of a volatility spike, which is normal in this market, and I'm not even putting much into that, we are looking at a profit across that entire range. So once again, very, very tightly controlled. The risks over the majority of the life of this trade are quite low, and we have potential for making 20 to 25%, and it's a great hedge trade at the same time. It's just literally a built-in hedge in your portfolio. So if we're committed to this one, if we like it, I'll size it and fire it. If we want to move on or bored with the idea, we can move on. Any strong opinions either way? Okay. Let's see about the size on this thing. So right now we're looking at $1.43 in credit. Let me clean up the volatilities. We're looking at $1.43 in credit on a $7 spread. So costs on this, let's just say $1.45. 7 minus 145 is 7 minus 145. $5.55 is the margin on this trade and effectively the max loss we could take. I'm going to put in, to be honest, I highly doubt that we will hit this, but I'm going to put in and size it based off of 40% stop loss. We should be making a decision to exit this well before we ever hit that stop loss, and the only way we would hit this stop loss is if we waited until the very, very end of this trade and let the stock go, way down on us, basically hitting that valley of death that we were looking at. But I'm going to size it out similar to some of the other trades. I could literally size this on a much safer, ratio. Say estimate a 20% drop, and I think that would be perfectly fair. But I'm going to use 0.4, which is 40%, which means that we lose $222 for each one of these if we were to hit that point. So if I'm going to do $2,500 worth of risk, which is 2.5% of our $100,000 portfolio, that is 11.26. Okay, I'm just going to go with a nice clean 10 and call it good. So here we have our trade, everything looking good. Check, check, check. There we go. See if we can get a fill on that thing. We're going to have a couple of rules on this trade. I'll kind of lay those out for us in the alert. One rule is that I do not want to hold this into the last week of the trade. So if we don't see a strong indication that we are well into a profit, or not into a profit, but past our break-even point at expiration by July 7th, then I am basically going to close this trade. If I see us languishing in the middle here, even earlier than that, probably evaluating it around June 30th or later, I would probably exit the trade. On the other hand, we could have also gotten a big gap down and be heading down, and I could stick in the trade too if I wanted that, because we'd be heading in a direction that's going to be netting us a good profit. Now, I've got a question for you, because we have a choice. I can put a profit target in this trade, and we could just use that to get out when we have an opportunity to exit. But if the thing gaps down, I'd probably hit my profit target. One thing that this trade could be used for is an overall portfolio hedge. Market goes into a major correction, SPY is going to be heading way down, and this thing could potentially be making some huge money for us. Volatility would be going way up. Quick little thing here. If we had a really large movement, volatility on the SPYs isn't going to go up 5%. It's going to go up 25%. That right there is what you could be getting out of this if we had a really big correction. I'm talking you're 7 to 10% down. So one thing we may want to consider is having a profit target that cancels itself if SPY drops below, say, 239 or something like that. Now, what this would allow us to do is use the profit target if it goes up and if we make the money the way we want, but also at the same time, if the stock market crashes and drops, it cancels the profit target, allowing us to make the greater profit as it goes by. We'd have to pick a trigger point that's close enough that it would trigger it before we actually hit our profit target, which shouldn't be too hard to find, probably somewhere around 242 or so. If it drops below that, we would have to probably it's just wiggling around, we'd have to reset our profit target. So, sound like a solid game plan for everybody? Wondering if Amazon is a good trade to take? Possibly a volatility trade, Sandeep, but I think my personal opinion, here's my 2 cents on that. The absolute worst time to take a trade is when things are chaotic because you have very, very little understanding of what's going to go on. If you can use the spike in volatility on Amazon to your advantage and maybe use that as it settles down to create a trade that gives you a nice edge, those certainly can be excellent trades. But if you're doing anything that is longer term or directional, I would probably say, I will flat out say I don't touch those. I want to take trades when I'm very comfortable about what's going to happen. And there's a lot of people forming opinions right now about Amazon. Good opinions, bad opinions. I don't even know what they're going to end up being. But it introduces a lot of risk. Volatility trades can be great. Directional, longer-term trades can be a little scary. I generally stay away from those. Stay away from them about the same way that I do my best to stay away from a land war in Asia and trading anything in the Middle East. But, okay, so we've got a general game plan here. I'm going to send off this trade in just a second. If we have time, I will try to knock out one more live trade, but I have to be out of here by noon. Sandeep, absolutely. Can you look at the trade that I just took? Absolutely. We just got this fill. In fact, here is the trade itself. Came out pretty simple. We are selling short 10 contracts of the 245.50 put that expire on July 14th. We are selling or buying long 20 contracts of the 238.50 put that expire on July 14th. General game plan on this is I would like to see SPY move up, ideally past that 245 strike. 245.50 and 238.50. I would love to see SPY move up past 245.50 as we get further into this trade, and if we do, we just let it expire near the 14th of July. If it moves far enough past that, we'll close out and take an early profit on it. If we hit that 245.50 area, we're hitting roughly a 25% profit on the margin of the trade. We can put a profit target in that basically is going to close this thing out at 20 cents or so, maybe a lower cost. I'll kind of work in a profit target. If we hit that early, I'd be happy to take it. I will have a stop limit order on this trade that basically closes this trade out when the price of this trade, let's see, 145 plus 222. When we hit 365, when the price of this trade hits 365 to buy to close, that would be the point where we would be just shy of our 40% stop loss or eject point or get the heck out point or whatever you want to call it. I would use that as a stop limit trigger order, which would then put out an order to close at probably $3.67. Now, the spreads on SPY are very, very tight. We should have no trouble at all exiting the trade. So giving it 2 cents should get us right out of the trade. That would be the equivalent of a stop loss order without the worry of having, stupid fills on an actual market order. So that was the other piece that we would put into this. Now, I would want to close any profit target on this trade or just cancel the order if SPY drops below, I'm going to say 242. Hold on, where are we right now? I don't want it to be 242. I'd probably say if it drops below 240, I would cancel out our profit target. Now, I might have to replace it if it's just drifting down and touching that. But what I want is if the market drops suddenly, what I want is to leave us room for this thing to keep going and actually make money on the downside. And if we leave the profit target in there, it's going to get hit. We'll get a profit, but we won't get that really big boost that we can use as a hedge for the portfolio. So I'm going to basically build that into the trade. I'll list all of this stuff in the trade alert that I'm going to send out in just a minute. All right. I'm sorry, but we are hitting 12 o'clock here. I need to do one thing. We still have not gotten filled on VXX. I'm going to replace this. God, I should have taken that 55 cents when I had the chance. Oh, well, coulda, woulda, shoulda. I'm going to drop this down to a 54-cent credit rate now and replace it. I want to be out of this. As soon as I see another fill on this, I'll send you an alert. But just realize everybody really should be working to get out of that VXX trade before the end of the day today. I don't want to see you left with the exposure for the delta movements I talked about or for theta erosion that I talked about. So there is that. Any questions? Brett, I think you're winning on the price in that close so far. Anybody? Yeah, I'm just going to set up the alerts and everything as soon as I leave here. So I'll try to give you all the details as I go. I'll even do copies of the actual orders that I'm placing in Thinkorswim so you can see the actual orders. But if you don't have Thinkorswim, just follow the concept. Every brokerage should allow you to do that. All right. I got to go. It's been fun. Thanks for showing up on Friday with me. Sorry for shifting the schedule. I will see you all next week. By the way, just to give you all a heads up, I think that we're going to be doing some new education series coming up. I think we're targeting for early July. I'll give you a heads up as they're going. Love to see some of you in the sessions. But I will see you all later. Oh, Father's Day. Oh, that's right. I'm a dad. Actually, Luther, you know what's cool about this weekend is my daughter's turning 7. And my wife has got a very big party set up, way bigger party than I would do. But she's a miracle worker on these things. She's actually got a 24-foot blow-up water slide coming in. I'm in charge of the burgers. That is, that's my job. Try to keep the area clean and make sure the kids don't kill themselves and cook the burgers. But that's my fun weekend. All right, everybody. Thanks a lot. I will see you next week, and have a good weekend. And for all you dads out there, happy Father's Day. And if you're not a dad, you probably have one, tell him happy Father's Day.